I'm here today with Toby Ross, who's one of the joint managers of the Scottish American Investment Trust, also known as Saints. Toby, Saints results have just come out, generally well received. What are the one or two things you'd draw out?
So the first thing I'd pick out is just the earnings growth for the company for the year was strong and ahead of inflation, and that has enabled the board to increase the dividend by 3.6% to 11.5p, and that increases the company's run of dividend increases to 39 years, which we're very pleased with. The second thing I'd pick out, though, is what's enabled the strong earnings growth and the company's put up its dividend, and that's really strong operational performance from the businesses that we invest in for the equities portfolio. So as you know, when we're picking companies for that portfolio, we're really looking for two things. We're looking for an ability to pay a dependable dividend and strong real growth potential. And over the last year, most of the holdings delivered both of those things. And in particular, we've seen a number of businesses benefiting from the digitisation of the economy, if you will. So a good example of that is Edenred, the French meal vouchers business, which had a phenomenal year as it took its vouchers from paper-based systems to digital ones, enabling it to serve more customers more cheaply a wider range of products. And that strong operational story is repeated across many of the holdings during the year.
You mentioned the healthy rate of Saints dividend increase above inflation, and that takes the yield up somewhere above 3%, which is a healthy yield, but it's not the highest that's available in the marketplace of companies or indeed investment trusts. Why should income-seeking investors invest in Saints?
Yeah, we think this comes back to one of the big conundrums facing income investors, which is, what is it I'm looking for? And we think most income investors got a very long-term investment horizon, and what they're really focused on is long-term income, not the short-term yield. And to test this out, we did some work last year looking at, how much income did investors who invested in a bunch of different UK equity income funds 15 years ago, how much income did they actually get? And what you can see in this chart is that if you invested in the highest yielding funds, you didn't really get much more income than you did if you invested in the lower yielding funds. The lower yielding ones grew faster, the higher yielding ones all cut their distributions in the crisis because they were up to their eyes in banks and oil companies. But the lower yielding funds delivered much stronger capital growth. And we think that's because they were less restricted to just the higher yielding parts of the market. They had more choice. So there's a really important moral there for long-term income investors. Don't get distracted by the high near-term yield. Focus on resilience and focus on growth.
Okay, and that's true in general and for Saints too.
Right, of course. And then because if you look at how Saints delivered, it again delivered as much income and much more capital growth. And in Saints' case, I think a kicker there was the fact that it's a global it has a global universe and a growth bias. So again, it had an even wider opportunity set. And I think those attractions are as valid today as they were 15 years ago.
So thus far we've talked mainly about the equity investments and how well they're doing. But what about the property investments?
Yeah, you're right. So the bulk of Saints' assets today are invested in the equities portfolio, but the property portfolio is a meaningful chunk, and that's managed on Saints' behalf by Olim, a specialist manager in London.
Picking up from the property, obviously that investment is linked to how it's funded and Saints borrowing. Could you just say a little bit about that?
Yeah, so as you know, one of the benefits of being an investment trust is the ability to borrow for the long term, and for Saints we then use that to invest in assets which can enhance our income stream. And at the moment that's the property portfolio. The good news there is that our current quite expensive borrowings will mature in 2022 and we'll be able to refinance those hopefully with something much cheaper. And so that's something that shareholders can look forward to over the next few years.
And finally, obviously, we're living in interesting investment times, as they say, the saying goes. What are your thoughts about the outlook?
Yeah, it certainly is an interesting environment, and there are many things out there to worry about. And as you can imagine, we've done some testing of the portfolio for resilience in the face of trade wars or Brexit scenarios. And so we do think about some of those threats, but we think it's important to spend most of our time thinking about the opportunities and where growth is going to come from for the portfolio. And actually what's encouraging for James and myself at this time of year is we're starting to get the operational results from our underlying holdings. And generally they're actually very strong. And we've seen some really remarkable dividend increases from companies in the portfolio. So Kering, the French luxury goods company, dividend up 75%. Wolters Kluwer, the Dutch information business, 15%. Analog Devices, very similar, the US chip manufacturer. So we think underlying growth from our holdings is actually very good, and the management teams remain very excited about the outlook. And that's really what gives us confidence for the year ahead.
Good. Toby, thank you very much.
Thanks, Dan.